Graphex Mining has announced an $80 million funding package from US private investment fund Castlelake, which sees the company fully funded for the development of their Chilalo graphite project. This announcement followed the updated pre-feasibility study from earlier this month, which again highlighted the robustness of the project. Following both announcements, we have reviewed and updated our valuation for Graphex to $1.51 per share. This analysis reviews the funding package, as well as discusses the factors which impacted our valuation. This is an excellent outcome for Graphex, as project finance is perhaps the greatest risk associated with a junior development company. To have a fully funded solution in place significantly de-risks the company and elevates them past the majority of other developers in the space. We also understand this is the first fully funded solution offered from a Western backer for a resource project in Tanzania since the changes to the country's legal framework for resource projects. Investors should also gain additional comfort and confidence by the quality of the partner in Castlelake, as they are a highly reputable global private investment firm with assets of approximately $14 billion. Castlelake has also been one of the most active financing partners for ASX resource companies over the past 15 months, as they've assisted in financing more than $400 million in development. We do note this will be their largest equity position in an ASX company, and also the first time they have offered a complete financing turnkey solution, which again highlights their belief in the project. Our valuation for Graphex has slightly reduced to $1.51 per share. While slightly lower than previous guidance, it is still significantly higher than the current share price, despite keeping the discount rate at 14%. The major reason for the change in our valuation is due to the difference between the Castlelake funding package compared to the previously mooted Chinese offer. As the Castlelake offer sees a significant increase in our assumed future dilution due to lower debt assumptions and no divestment of the project at the asset level for cash. However, this increase in dilution is largely offset by the company maintaining greater ownership of the project at the asset level. And whilst capital costs were lower due to reducing the initial size of the processing facility, we assumed additional costs on top of the PFS assumption to account for additional working capital as well as capitalised financing costs. However, the updated PFS also saw an increase in throughput through the Stage 2 expansion that we believe will be fully funded through internal cash flow. Once this occurs, the project generates exceptional returns driven by the robust operating margins, one of the most significant in the industry due to the quality of the saleable product. Finally, the company is currently completing an infill drill program with the aim of increasing the confidence level of the resource. Assuming success with this program, which is highly probable, the mine life will extend, resulting in a further increase to our valuation.